Today's episode is brought to you by MetaMask Portfolio. You'll be hearing more about them later on, but for now, let's get into today's interview. Happy to welcome to Forward Guidance Aidan Garrib, Head of Global Macro Strategy at PGM Global. Aidan, welcome to Forward Guidance. Great to have you here.
Yeah, thanks, Jack. It's a pleasure. You do great work.
Appreciate that. So Aidan, you do a bunch of things. I'm sure I could throw any topics at you, term premium, stock valuation, what the Fed is going to do, oil prices, and you've done some thinking about it. You're going to have an answer for me. But I want to spend a good part of our conversation about China because you just put out a report that had some fantastic charts I thought was really thoughtful. And I think my coverage on Forward Guidance has been lacking of China. And I'd say broadly that people if they are talking of China, it's only doom and gloom. And historically, I've found that when everyone's talking about gloom and doom, that's where potential opportunities are. And you saw today, as we record the late morning of October 18th, that Chinese growth actually exceeded expectations. So perhaps is China exiting a recession rather than in the middle of one? Aidan, what is your overall broad view of China as we sit here today?
Sure. Well, I think, first of all, I would say the Chinese economy is, I think, pretty misunderstood by Western investors who, the biggest disappointment, I would say, in financial markets over the last few years has been the disappointment of China's reopening trade. However, if you paid attention to what the Chinese policymakers were telling you and where they were allocating capital and their growth plans, then I think investors wouldn't have been disappointed because they would have been, investing along with what the PBOC and the CCP were telling you they were going to do.
What do you mean?
I think a lot of investors have expected that China's growth would, in the reopening would take place in similar fashion to how it did in the West. So, for example, that you would see pretty big, fiscal transfers to household to kind of buttress them through the pandemic. You would see a return to the dirty fixed asset investment, the roads and bridges to nowhere, the empty apartment buildings that we've all come to know and love out of China over the last, call it 15 to 20 years. However, I think the structural features of China's economy have changed, right? The notable one has been China has gone from having a working age population that's growing by 5-10 million people per year to now an overall population in decline, and perhaps more importantly, a working age population that's declining by about 5 million people per year, and that by 2030 will decline by 10 million people per year. So all to say, unlike a decade ago when China's working age population was growing, and the CCP needed jobs at any cost, empty apartment buildings, sure, roads and bridges to nowhere, just do it, create any of those jobs. In the context of a declining working age population, they need fewer jobs, but they need higher value added, higher paying jobs so that they can restructure and reorient their economy towards consumption as opposed to, lower value added exports and CapEx that's not really accretive to growth.
And there's some folks who say that China really can't make it in its transition from an investment-driven economy to a consumption-driven economy, such as the U.S., and that's there's going to be a really painful transition as it makes that move. What do you think?
So the transition isn't going to be smooth, and I think if you're an investor in Chinese equities or you're looking at Chinese growth, you're seeing kind of the frictions in that approach currently and how difficult it can be. But there have been quite a number of green shoots showing that China can come up the value chain, diversify its economy, and produce higher value added exports that allow China to become a more consumption driven economy. For example, one of the things I point at is if you look back to 2015, China came out with its Made in China 2025 plan. And so if you look at what, kind of the experts were telling you, about that plan, so for example, a quote by the Center for Strategic and International Studies basically summarized China's 2025 plan by saying the plan seeks to raise the domestic content of core components and materials to 40% by 2020 and 70% by 2025, across a variety of high value-added products like aviation and aerospace, electric power, new energy automotive, high-end robotics, etc. And so what I would then say is, well, look at some of the progress that China's made in that regard. The number of industrial robots that China puts out every single month has just continued to grow. Last month they put out 33,000 robots. That were hovering around 40,000. But just to kind of put things back into perspective, McKinsey Global Institute, so kind of the think tank for the McKinsey consulting company, had come out in 2020, 2021 and highlighted the market share of Chinese firms in China and in the rest of the world across a variety of high value added products. So you take electric vehicles, for example. In 2020, the market share of Chinese firms in China was 95% for EVs. Globally, it was about 5%. You fast forward to today, and I kind of sent you these news links where China has overtaken Japan as the world's top car exporter. There was an article from the Wall Street Journal titled "Your Next Electric Vehicle Could Be Made in China," where they highlight that around 35% of EVs exported globally come from China. So you're seeing, just from 2020 when they had a 5% market share to today, where that's grown to 35%, right? Or even something perhaps more visceral that's made the headlines more recently is, Western governments, spy agencies, kind of security agencies have been surprised by the new Huawei smartphone and the 7 micron or nanometer chip that's in there that is essentially on par with an iPhone 12, which isn't that old. And so even though we've been pushing these trade restrictions and sanctions on China, you've just seen how quickly they've actually developed in this regard. So I hope that answers your question, Jack.
Thanks. And what about the Chinese stock market? Okay, China, it's building tons of electric vehicles. It's moving towards high value sectors. That's great. But the stock market is in the tubes. And I'll just put a chart up of, excuse me, actually, I'm going to move over here. This is the chart I want to show, showing in light blue is MSCI China, so an index of Chinese equities, showing that for nearly a decade, the total return since a year ago, 9 years ago, is basically flat. Probably get a little bit with dividends, but actually foreign holding of Chinese stocks has gone up. And as Chinese stock markets crashed from 2021 to late 2022, the equity holdings from foreigners, it went down a little bit, but not by much. So I would imagine that foreigners are holding on to their stocks, whereas local citizens of China and Chinese companies are dumping their stocks. So what I would ask you, what do the insiders in China, what do they know that the dumb foreigners don't?
I wouldn't say it's the insiders are necessarily selling stocks. I think there's just been some compositional shifts with respect to how foreigners purchase stocks and the type of foreigners by asset class, I guess, or by investor type that are buying and selling. So, for example, the foreign holdings in Chinese equities there that you'd seen via the MSCI China Index. So for the passive investors, because China is such a big weight in the EM index, about 30% or 27%, they've not sold. What's happened is you've seen two things. One, the China Stock Connect flows have diminished significantly. So foreign, like institutional money managers have been selling out of Chinese names.
And sorry, what is the Stock Connect? What is that?
So the Stock Connect is basically the platform that allows foreigners to use kind of Hong Kong as a base to then buy mainland listed shares in China. And they just do that because of the, the dual currency CNH versus CNY and the closed capital account. So they've just tried to manage how investors can go in and buy Chinese equities. When you look at that headline number, the passive flows haven't really diminished all that much. But what's happened is kind of a couple of things. So when Russia went and invaded Ukraine, a lot of investors said, well, okay, this is going to be bad for Russian equities. We can't invest in those anymore, but also commodities are becoming more important. What do we do? So they shifted out of China, out of EM Asia, out of Russia, and they went and they bought like LATAM equities, for example, because there was a pretty good substitutability between the commodity components in LATAM equities and then Russia. And then kind of following that, you had investment start to come back into Chinese equities over the last year, let's say, but then that was disappointed with the reopening. And so then those types of benchmark hugging, investment managers then went and looked for alpha elsewhere. And actually, one of the places that you're seeing the active flows go is actually India. So if you, for example, I have a chart that I'd sent you that shows the net equity flows going between India and China and the relative performance that's driving between MSCI India relative to MSCI China. And so, I think that helps explain some of the divergence you're seeing where the passive managers are still buying and or holding the Chinese equities, but the active managers who are looking to outperform the benchmarks have been, kind of chasing returns first in LATAM and then now in India.
So that's a good point on the flows. Let's talk about the fundamentals. You've also got this fantastic chart showing decomposing the returns of MSCI China. As I said, for close to a decade, the returns now are close to zero. So the total return is 4%. The market is down a little over 10%. But you're getting 16% in dividends. So that's how that plays out. But earnings contractions, EPS, that is negative. So, US stocks, and I imagine even Europe, they've had earnings growth. It's normal. Companies grow their earnings. That's what they're supposed to do. But the Chinese MSCI index their earnings are 26% lower than close to a decade ago. If the Chinese economy is, so what is going on here?
Yeah. So what's happening, and this kind of plays back into the structural kind of changes that you're seeing in China, is a lot of the banks, the finance companies, the state-owned enterprises, they haven't necessarily been run for profit reasons, right? They don't have necessarily a strong profit motive. They are run at the direction of, policymakers there. When you add massive, debt increase that's largely been in the corporate sector via the local government financing vehicles, which we can get into because they actually play an important part here. I think that's where a lot of the kind of that debt overhang has been. And then now what you're having is central bank and government policy to basically take that corporate debt, take that local government financing vehicle debt and pull it back onto the official, provincial or central government balance sheet, or actually the PBOC balance sheet, and work to delever the economy that way.
Today's interview is brought to you by MetaMask Portfolio, your one-stop shop to manage your crypto assets and access a range of Web3 services all in one place. Overseeing your crypto assets across different wallets and networks can be very complicated. MetaMask Portfolio solves this by giving you the reins to manage your crypto from a single decentralized application, or dapp. Just connect to MetaMask Portfolio to get a bird's eye view of all your coins, tokens, and NFTs, and you can easily buy, sell, swap, bridge, and stake crypto assets at competitive rates right within the app from a vetted list of providers. No more jumping between dozens of sites and apps. MetaMask Portfolio lets you do more in Web3 your way, giving you secure and convenient access to a wide range of features and services all in one place. Manage your portfolio your way with MetaMask Portfolio. Click the link in the description of today's episode to get started. Thanks, let's get back to the interview. So now let's take a little bit of a dive into the debt. You've got these 4 charts here. And when I was growing up, I would always hear, and I would think, because you think what you hear, that US has a ton of debt and China has no debt at all. And we owe China a ton of money, which is true. China owns a lot of US treasuries. But I love your just decomposition of these top at the charts of the leverage in a debt to GDP sense of China on the left in the top versus US in the right. And so China has a lot less government debt, but a lot more corporate debt or bank debt. Let's zoom in. Yeah, a lot more bank debt.
Well, the way it's showing up here, a little bit of bank debt at the top, but really the lion's share of debt in China is that dark blue space, which is the corporate section there. And that's really due to the fact of, from a definitional perspective, the way that the structure of debt is kind of laid out in China puts it on the corporate balance sheet, both in terms of traditionally like kind of over levered corporates that you're seeing right now with some of the property developers. But then also, if you look at the local government financing vehicles, technically those are kind of like distinct from the provinces. So that's where those portions of the debt are. And so in aggregate, yes, China has more debt than the US. It's just the composition is slightly different. And so what China is doing right now is essentially pulling a lot of that corporate, quote unquote, debt and putting that back onto the government balance sheet via the provinces and also the local government balance sheets, and using the banks as an intermediary to do that.
What are the types of companies that are borrowing? Is it a lot of banks and that borrowing is counted as deposits, I guess? I don't know, as liabilities? Or is it, is Alibaba, is all these companies, where is the leverage,
Yeah, so the leverage, I would say, in this sense, isn't the banks necessarily. It's corporates. So it's firms specifically over the last couple of years trying to roll over debt, but it's just large and small firms that have been taking out debt from the banks, and then also the local government financing vehicles, which are the shadow entities of the provincial governments that have, I would argue, and it's a bit opaque, but I would argue that's where the lion's share of that corporate debt isn't the LGFVs, local government financing vehicles.
Okay, explain those LGFVs.
In China, the central government dictates the priorities, and it's up to the regional governments to essentially carry those priorities out in the way that they kind of see fit for them. So if the central government says, hey, region A, we need you to growing regional GDP is important. Okay. Well, what the central government does is it gives bond quotas to the provincial governments. So the amount of debt that the provincial governments can raise. Well, oftentimes that debt isn't sufficient to drive growth in that region. But the local governments can't issue more debt than what that quota tells them they can do. So how do they get around this? Well, they set up a local government financing vehicle, so kind of an arm's length entity that will issue bonds. Those proceeds will go into kind of urban redevelopment. So I don't know, maybe they're building a train station or a port or a shopping mall or something. And once they finish that, urban redevelopment project, it ends up lifting the land values of the land surrounding that redevelopment project, which just that land happens to be owned by the provincial governments. So then the provincial governments take that land that's increased in value, sell that to the property developers. The property developers will go and build apartment buildings, houses, condos, etc., pay the provinces, and then the provinces will then funnel the money back into the local government financing vehicles to pay off that debt. So it's just basically this financing arm where the local governments will, redevelop land, which increases the land values. The provinces can then sell that land for elevated values to the developers, and then use that proceeds to pay off the initial loans.
So is it somewhat similar to a VIE, variable interest entity, or a special purpose vehicle?
Yeah, more or less.
But for the government.
But for the provincial governments, yeah.
Okay, interesting. So I guess a lot of that corporate debt is for real estate.
Yeah, which is I think it's the largest asset class in the world with a capital TAG.
Yes, and how is the Chinese real estate market faring? You had some charts which actually they look bad, but they looked not as bad as I would think, which is actually a scary thing because if property prices in China, if what it takes to wreck the Chinese economy is not property prices falling, but them not just going up. So here we've got the property cycle for tier 1, tier 2, and tier 3 cities, and you see a series of property boom and bust in 2011, 2013, 2015, and then since about 2017, the property market has been somewhat quiet, and it's not like prices are collapsing. I mean, year over year for tier 1, they're pretty much flat. They're falling a little bit for tier 3 and tier 2.
Yeah. So, the big tier one cities like Shanghai, for example, you've seen the house prices there slow. The smaller regional kind of rural tier three cities, that's where the price depreciation has been the most acute. Um, and what you've also seen has been the government, like destroying some of the overcapacity. And so as house prices have moderated, or in the case of tier two and tier three cities, outright decline, that's actually been one of the major drags on the animal spirits in China and consumption. Um, We'd mentioned that Chinese real estate is the largest asset class in the world. It also comprises about 37% of household assets. So I'm sitting here in Canada, which is also a country that has let's call it a love affair of real estate. And so I can imagine what the consumer confidence would be here if house prices were falling by 5, 10, or 15% per year. They'd be pretty diminished as well. And what's actually interesting on the screen that you're showing there is on the top right, I break down Chinese loans to households and non-financial corporates. And so again, this highlights exactly this fact. So if you look at I know it's a bit maybe messy. So the dark blue line are short-term loans. The light blue line is mid and long-term household loans. And then the red and green are short and long-term loans to non-financial corporates. So most of the loan growth that we've seen really since COVID has been going towards the non-financial corporate sector, again, to help them like roll over the debt amid the shutdown economy. In contrast, households have been delevering, right? You can see very clearly that mid and long-term household debt, that's actually been slowing quite dramatically because, what do you do when we've locked down the economy? We're not giving fiscal stimulus. And your house prices, which are 37% of your assets, are going down in value. Well, you're going to delever. And so that's broadly what you've seen. More recently, you've seen a little bit of an uptick here in short-term household loans. So really what I think is happening is the government just needs to effectively come in and help buttress some of the stabilization that it looks like you're seeing in the Chinese households. The problem for the central government and the regional governments is one of inexperience and one of incentives. So what I would say by that is the central government doesn't really have a track record of direct fiscal transfers to households in much the same way we've seen in the US through COVID and Canada and in Europe. And kind of on top of that, Xi's come out recently and his remarks seem to suggest that he doesn't really favor that approach because it would make like the Chinese people soft, quote unquote, to kind of paraphrase what he said. So he doesn't want to go through the direct transfer mechanism. The other thing is there is some disincentives at the regional government to kind of kickstart growth much in a much faster fashion. And so what I mean by that is historically, if you look at the incentive structure of a regional politician, it's to grow the GDP of that region fast and at a faster degree, let's say, than your neighbor, because that's showing, hey, I'm actually a better politician and better leader than, the person running the region next to me. And so what would happen is if they gave, let's say, Jack, you and I are two regional governments in China, and maybe I'm an export-oriented one and you're one that makes kind of like electronics for the local market. Well, global goods demand is pretty weak right now. So if we gave everybody, cash stimulus, then people in my region wouldn't buy products that are made in my region. They would buy some of the products that are made in your region. So it'd kind of be like a intra-country import imbalance, let's say. And that would make you look really good because your economic growth is growing. But it would make me look not so good because, my economic growth in my region is not growing. And so that's why you've seen some of these rather like lackluster and ineffective policies like vouchers for haircuts. So, you're not going to grow, GDP in China by giving people vouchers to go get haircuts, right? It might work to support some local economy stuff at the margin, but, in aggregate, it's not going to have a pretty sizable impact.
Right. And is there also sort of a feedback loop where if I'm doing really well, my GDP is at 10%, you're not satisfied with 8%. You're going to go to 12%, and then I got to go to 14%. Whereas if I'm at 2%, you could beat me by going to 3%.
Yeah. So it's that within the context of an overall crackdown on credit and property sector credit, which is the main way that these politicians know how to drive growth, because that's what they've been doing for the last 15, 20 years.
And so tell me about the crackdown on credit. I think it was called the three red lines. Has that been rolled back? And how, when we showed the chart of medium-term household debt has, growth has sharply fell. How much of that is due to regulation and the crackdown on credit, but the government sort of incentivizing banks not to lend or companies not to lend, versus just the economy is weak, so banks are not going to lend?
So I think it's a couple of things. So the government, as it pertains to real estate, what the government has tried to do right now is essentially just get the property developers to build what they have sold but not yet started or not yet finished. Because in China, the way the property market there works is once you sign the contract, you start paying the mortgage, and a lot of the Chinese were protesting because they were paying mortgages for projects that just weren't getting built. And so I have some charts in this slide that shows, if you look at the real estate activity that's taking place, you can see China's residential floor space. And you can see, again, that blue line, completions, that's all that they're really doing. You're not really seeing much new construction. You're not seeing many sales. You're not seeing actually projects being started. More to the point, and this kind of is a good segue from what China's growth model has been to where it's kind of going, is if you look at the top left-hand chart on this page, you'll see that when you look at credit growth in China, so for, from 2012 to, let's say, COVID, that green line was where you saw all the growth. So real estate. So most of the credit growth in China was going to the real estate sector. And then, since COVID and the crackdown on property, that's actually slowed quite dramatically. And you're seeing the industrial capex actually take the lead. So this is, again, helping to build out that, the electricity grid, better water distribution. So water distribution, electricity, building out like the factories and making those more efficient, the industrial robots, all those things that I'd kind of highlighted in some earlier slides with you.
So if you're a real estate developer, it's hard to get credit in China. But if you want to build an electric vehicle factory or an engineering plant, the spigots are on.
Yeah. So the one, I guess, portion of, or aspect of nuance I would say in that is, if you are a real estate developer who needs some financing to complete a project that's already been sold, then I think the government and the banks are accommodative of that. But to your point, yes, like they have realized that the turning on the spigot full way into the real estate pocket of the economy, that was the growth model that China employed over the last 20 years. But actually credit to this kind of newer or higher value-added pockets of the economy, that's where the credit's going to start going from now on.
Tell me about the systemic effect to the Chinese financial system of the failure of several, or potential failure of several, large real estate firms. The most conspicuous one is Evergrande, which over 2 years ago was teetering on collapse, and I thought of as bankrupt, and it unofficially was bankrupt, but it's actually taken 2 years for it to officially default. So just shows how long these things can take. In America, you have a collapse of something like Lehman Brothers, and that has a cascade because it's a counterparty. Evergrande, real estate firm, not a bank, although it had its hands in many different types of areas. But what is sort of the systemic risk within the real estate and banking sector? Because real estate and banking are very related.
Most of the defaults that you've seen have been on the offshore bonds in China. So for example, on the bottom right, you can see this, Chinese bond default rates onshore and offshore. So there were, kind of foreigners that were buying largely FX denominated debt. What the authorities have been trying to do is ring fence the domestic economy and the banks from that. And you can see this in kind of a number of ways. So this is actually a great page for the slide decks, because what you're seeing on the top left is the local government bond issuance. So that is basically surged, right? And so the local governments are now issuing bonds backed by the banks, and you can see this on the top right. So if you scroll over a little bit on the top right, you'll see net financing of corporate and government bonds. So the financial system is essentially helping to finance the issuance of the red line there, which is government bonds, largely the provinces. And then in turn,
is the banks buying that? Private
yeah,
citizens are buying it?
yeah. And so there was some other slides where you could see like the PBOC's balance sheet, where essentially what they're doing is claims on banks or depository institutions are increasing. So they're basically giving, like, PBOC is printing money, giving that to the banks. The banks are then buying provincial bonds, which the provinces have been incentivized to issue. And then the provinces are using those proceeds to essentially buy back the local government financing vehicle debt. And what this is doing is it's creating a bifurcation in the credit market where the provinces and the local governments are looking better from a credit perspective than is traditional high yield in China, which you can see, exactly on that bottom left-hand chart on page 8. So these are...
Is that red line high yield, is that US high yield or China's high yield?
That's China's high yield in US, so the USD bonds, basically. And so you can see that historically, there's been, well, at least over the last couple of years, in terms of prices, they've been very correlated until very recently, when the local government financing vehicle bonds have been performing much better than traditional high yield. And this speaks to the fact that, the authorities are really trying to ring fence the domestic financial system and pull a lot of that debt back onto the balance sheet of the government.
So China is trying to shelter the domestic Chinese financial system from defaults, but all of that excess is sort of pushing the wastewater out to the rest of the world. I respect that as a China, if Chinese, they want to protect their national financial system, but the rest of the world probably doesn't like that, right?
I mean, yeah, look, if you're a hedge fund and you were buying some speculative grade, dollar bonds in China trying to pick up a yield, then you're clearly not going to like the defaults. But I think that's maybe a small price to pay if you're the Chinese authorities in your cost benefit analysis.
Tell me about what's going on with the yuan. I know it's been weakening, but the yuan, is the yuan pegged or is it not pegged? Because it doesn't typically move that much, but it has been moving.
It's an odd question. It's more like a stable crawl where the government just wants to make sure that the moves aren't abrupt, let's say, right? And so they set a fix, and which is basically, telling the banks, hey, we don't want the currency to move more than this. And more recently, that really hasn't been enough, and the currency has been weakening a little bit more. And really, I think that just comes down to the fact that on paper, China has a closed, capital account, let's say, but they do want entities coming in and buying Chinese equities and buying Chinese bonds, and there's a lot of fixed asset portfolio flows and other kind of longer term flows going into China. So in reality, it's not as shut as you would necessarily, or not as closed as you'd necessarily think. And so there has been some depreciation in the RMB, which is problematic, I think, if you're the Chinese. I think what maybe mitigates some of the risk of the weakness that you've seen in the RMB has been substantial delevering of FX denominated debt over the last couple of years. But then also China's been doing a pretty good job of denominating commodity trades in its own currency, which I have some slides on there. And then also, by buying discounted Russian crude and exporting that refined product, where, the refineries are running at basically 80% of capacity and they're exporting quite a bit of it, that's helped kind of shield the economy from the weakness that you'd think, given where the RMB is.
And then Chinese interest rates are quite low, I think around 2%. Is that stimulative? And then also we should say that unlike a lot of the world, China does not have an inflation problem. And in some cases, some months it actually has deflation. So does that, could rates go even lower? And what's the impact on the financial system there?
In terms of the deflation that you're seeing in China, most of that is actually food prices. So I would argue that if you're the PBOC or the central government, that's not a terrible outlook for you to have like deflation being driven by food prices, because that's typically been like what they've struggled with, and what they've been kind of concerned about is you have pork and chicken prices rise quite dramatically, fueling inflation, and that leads to social unrest. So I'd argue that that's not a huge kind of negative for them. Yeah, when you look at the interest rates in China, they're substantially lower. Call it in like the 2% to 2.3% range. If you're looking at 7-day repo rates or 3-month interbank rates, could they go lower? I don't think so. I think what the government wants to do is have a less reckless approach to credit growth. So I don't foresee that going substantially weaker. And so I think they understand that you're going to have a weaker currency, and they're going to have weaker growth. Like, if nothing else, I think it's just, if you just start with the default position that like the Chinese policymakers aren't dumb, right? Like, they understand, hey, we've used credit for 20 years to drive a massive real estate investment growth model, and now we're not doing that. Then I think it's fair to say that they understand that they are going to have slowing growth, right? That, some of these problems aren't necessarily going to be a surprise to them. And so I think they're just more or less happy to let the animal spirits kind of like naturally take over as this long process kind of draws out, and then support that where possible, given the institutional constraints that I talked about with respect to like know-how, and then also, their lack of kind of really proclivity to fiscal transfers to households.
And then how would you describe the economy of China over the past year? Has it entered a recession? Because even though, again, this is the question of the nominal question, if growth slows from 8% to 5%, that's not a recession, but it is a pretty significant contraction in growth. And because China does not have an inflation problem, negative real growth is not negative. But I know unemployment, you're having a lot of sectors. So has China been in a slowdown? Would the slowdown be so significant you would have called it a recession? And is China leaving? Is it exiting recession? Which is, it's a good place to be, if it is.
I think it's very difficult to argue that China has not been in a recession. So I would say, yes, China has been in a recession. I think, for example, if you look at Chinese export volumes, earlier this year, they were contracting by close to 20% on a year-over-year basis. So it's hard to argue that if your exports are contracting, your households are delevering, and you're forcing deleveraging on basically the engine of growth over the last 20 years, the real estate sector, that you're not going to be in recession. So regardless of what the nominal GDP, like the nominal GDP numbers in China anyway, you basically throw them out because they target they tell you what they want real GDP growth to be, and it tends to hit that number. Mm-hmm. So I would just argue, if you look at the underlying, fundamental data, where it's, Chinese trade, or it's the Li Keqiang indicator, which tracks like rail freight, bank loans, and electricity usage, you basically show that, the economy has been in a recession.
And is it exiting a recession right now?
I would argue that on this, it looks like services are picking up and retail sales look to be bottoming here. When you look at, like, I think I have some charts there looking at, domestic and international passenger flight volumes. So the Chinese are, increasingly, going out and spending on services. And, it's actually interesting because a couple of months ago, if you looked at the luxury brand, so if you looked at, for example, like the big global coffee shop chains were telling you, and the big luxury brands were telling you, and you kind of sum that up, the view of what the Chinese consumers were doing was they were buying American brand coffee, luxury handbags for Europe, and then going to like Shanghai Disneyland, right? So it was more of like this domestic tourism story. Now, that isn't going to be what drives, growth long term, for example, but you are seeing that there are these bits of like uneven green shoots of growth that are taking place. It's just the government hasn't been as willing or able to kind of shore that up as much as they should have been, or one would have thought.
And then tell us about this chart, which shows the outflows from China, the net portfolio flows, which has been negative for a while. What is this? Is this stocks, bonds, and is this foreigners buying Chinese stocks, selling Chinese stocks? Is it China's banks? Are they selling treasuries? That people have been talking about China selling the treasuries, but I know also they have a little port in Belgium where they may be they actually are buying, even though it's not in China, on behalf of the Chinese government. What is this chart showing here?
Yeah, so what this chart shows you is Chinese portfolio net flows, stocks and bonds. And this chart is agnostic to who's actually doing the selling and buying. And that's just the granularity that you're able to get out of this series from the Chinese authorities. So it could be foreigners that are less negative on Chinese assets. So at the margin, they're not selling as much. Or it could be domestic entities that are pulling their foreign capital back into China.
Wait, I'm sorry, but if I sell, there has to be a buyer, right? If you buy, there has to be a seller. How could this? Sorry, can you explain this? I don't get it.
Yeah, so it could be, for example, that foreigners are less bearish on China, and so they're starting to come in and are buying proportionally more Chinese stocks and bonds that they had in the past. It could also be that Chinese firms are repatriating, kind of portfolio flows back into China. So maybe they want to, sell U.S. stocks or, global bonds and pull those proceeds back into China. Given like the capital account restrictions that you see, my inclination is that it's actually foreigners that are starting to come in again and look at opportunities in the stock and bond market in China. On your question on kind of FX reserves and treasuries, largely, I don't think it would show up here because China does have these entities in Europe. So Belgium is one place, but Ireland is another place where it would accumulate FX reserves. Also, China's, and this is something, I've talked to some of your other guests, like Mike Green and, Michael Cowan a lot too, is the fact that Chinese FX reserves, particularly like the short dated treasuries, they're able to essentially use those to lend into Japan and pick up a substantial like yield pickup over what you'd get just holding those nominal treasuries. So we're getting into the weeds of like FX swaps, but basically because the cross-currency basis swap spread between the dollar and yen is so wide, if you're willing to lend dollars into Japan, you can hedge the currency and then pick up like treasury plus returns with essentially no FX risk or very little credit risk, since you're just lending to the big pension plans essentially. So I don't think they would be actively selling down the treasuries. Just globally, what you've been seeing is slow global growth. And so if there's slow global growth, it means there's slow global trade. If there's slow global trade, it means there's just less FX reserve accumulation. And guess what? Since US treasuries are the world's predominant FX reserve asset, it just means that there's going to be less FX reserve buying of treasuries if you have slow global growth and slow global trade. And I think that's largely what you're seeing. Now, could they be some unease around geopolitical issues and the US maybe sanctioning treasury securities? Possible, but I think the two economies are so linked that I don't think that's necessarily what they're doing.
Earlier, you referenced a chart which we'll put up shortly of the percentage of currencies that are used for global trade, and I think the dollar doesn't even appear on the chart, the euro, because they're so high. So it shows just the renminbi usage, which has ticked up from 2011 from 0 to a little bit, but it's been somewhat flat. What are the Chinese ambitions for the internationalization of the renminbi? This is obviously nowhere close to
a dollar or euro, yeah.
But is that even part of the ambition at all, or no?
So I think China wants to be a global reserve currency. I don't think they want to be the global reserve currency. The reason being is if you are the global reserve currency, by definition, that must mean you import stuff and export your local currency. So, for example, if you're the US and you're the global reserve currency, you can't export cars and dollars. You need to import cars from Japan, let's say, and then export dollars, right? That's the way the system's gonna work. And insofar as there's global growth, the world needs a proportionate increase in dollars. So, for example, if you're India and the Indian economy is growing by 5%, the Indian economy needs 5% more oil. Well, guess what? It needs 5% more dollars to buy that oil, all else being equal. So what China wants to do is not replace the dollar or the US as the global reserve currency. Really what China wants to do is it wants to denominate its commodity trade in RMB terms. Because then, if you're the Chinese, you kind of win. You're like, look, we don't have commodities, but we can print red pieces of paper and then buy the commodities that we need with those red pieces of paper that we've printed. Like, great, sign me up, right? So that's what they're trying to do.
And sorry, why is that better than being able to print red pieces of paper that can buy green pieces of paper, dollars, to buy oil?
Right, because then what you risk is currency depreciation and then dollars rising and commodity prices rising. And so then your inflation rises, which then creates problems, right? Whereas like if you're printing it in your own currency, you kind of diminish those risks. And so as part of that, what you need to do is you need to give your export partners. So let's just say like Saudi or Iran or Russia, or whoever you're buying commodities from, you need to give them a reason or a way to essentially hold RMB, right? And so this is, I think, is another factor that plays into what China is doing with its bond market is, hey, if we can absorb this debt onto the government balance sheet, issue these bonds in a transparent way with a sufficient yield, then actually maybe these bonds look attractive to foreigners so that if we print RMB and we pay Brazil RMB for soybeans, then Brazil has an incentive to hold those proceeds in RMB in our government bonds because they are providing some sufficient yield and it's a pretty big, a deep liquid market, right? Because everyone talks like, hey, why are US treasuries the global reserve asset? Like, what is it about them that makes them the global reserve asset? Well, they're deep and liquid. What does deep and liquid means? It just means there's a lot of them and you can buy and sell them really with very small bid-ask clips, right? So, okay, well, that looks like what China is trying to do. And so what I show here on this page that you'd alluded to, page 18 or page 16, is after the dollar and the euro, the share of payments via SWIFTs, sterling is about 7% of that. And then directly below that is Japan and the RMB, which are both right around 3.5%. So, that might be something that most investors or most listeners don't know is that, look, RMB is as traded on, via SWIFT as is the yen. And then essentially when you look at the top right-hand chart on this page 16, I'm showing the trade in RMB as a percentage of total Chinese trade, which is about, over a quarter. So, China, I'm showing on I'm kind of jumping around here, so forgive me, but China is the largest trading partner for 120 countries in the world. And in line with that, about 26% of total Chinese trade is denominated in RMB. So they're halfway there. They are getting countries to take RMB. It's what do those countries do with the RMB after
Wait, say that last bit again. What's the half statistic?
Sure.
So half of all of the trade is denominated in RMB?
No, so it's a quarter, 25% as per the top right. Okay, so sorry, I maybe was going a bit too quick for the chart scrolling. So you can say on this chart, essentially what I was just been saying is that China is the largest trading partner for 120 countries in the world. And over 25% of China's trade is denominated in RMB. So what that means is, sure, China is getting more countries to take renminbi, for exports and imports. The question is, what are these countries doing once they've taken the RMB? Typically, what you do is you just dump the RMB, buy US dollars, buy US treasuries, and then do whatever else you need to do, right? But what China's trying to do is build out its bond market, and just give these foreigners a reason to hold renminbi, so that it's essentially creating some incentives to keep, to kind of keep that system going, where they can print red paper for the commodities that they need.
Now let's move on. Our final topic on China is just this transformation of opportunities. If it's moving, the credit growth is moving away from real estate to industry. Let's talk about that industry. So you've put up here some electrical stocks in China, as well as the KWEB ETF, which is the internet ETF. So clearly, and we're seeing on the bottom right here that there are Chinese companies that have grown their earnings tremendously, even over the past 4 years. Do you think that is China a stock pickers market where where companies, you can predict their earnings will grow a lot and the stocks will go up? Because I would say about the KWEB ETF, a lot of those companies have revenue and net income charts over the past 10 years that look exactly like Apple or Google, but KWEB also has been pretty flat over the past 10 years.
Yeah, so that's the great question. And so I think there are opportunities for bottom up stock specific analysts in China. The problem, as always, when you're trying to analyze China is, what's the data quality like, right? What are the accounting standards like? Can you trust those things? So, I'm more like, I run a macro team here. So luckily, that is not, something that I have to spend a lot of my time doing. But all I really try to say here is, look, if there's kind of like one lesson from China, it's if the authorities are throwing money at something, then there's going to be opportunities for return there for global investors, right? And what investors need to do is just realize where the money's not going, i.e. real estate anymore, and where it is going, which are some of these high growth, high value added sectors. So all I really try to do here is on the bottom right-hand slide, I'm just showing some of the Chinese electrical computer and equipment stocks, their trailing earnings, just the direction of those things to show, look, like this is where the Chinese government and the PBOC and the authorities are directing the money to. And then on the top left, I just highlight the stock prices for those firms, which may or may not have done well. And I think this is kind of the disconnect, and it speaks to, I think some of the disappointment among bottom-up Chinese investors, at least the ones I talk to, which are saying, we do a lot of the bottom-up work, the earnings are actually doing well, but we're not being rewarded in terms of prices, right? And so I think as increasingly investors kind of come to understand what China is doing, then that return can start to be harvested. And then also, Jackie picked up on a good point, which is the bottom left-hand chart on page 15. So this is the shares outstanding for these specific ETFs. And the reason I show shares outstanding is it gives an indication of what foreign investors, so Americans, Canadians, Europeans, et cetera, are actually doing. And so at the margin, they're not selling KWEB, right? Because you're seeing shares outstanding. I mean, it's down off the peak, but it's substantially high. When you look at these other pockets, these other ETFs, you can see that they're flat. So it looks like investors in Chinese equities and ETFs are taking a page out of like the crypto bros, which is just they're hodling, right? They're just they're going through the crypto winter, but the Chinese growth winter basically.
The Chinese growth winter has actually been longer than the crypto winter.
It's been Game of Thrones
style winter. So, but maybe spring is coming. Let's quickly, final thing on China is the different types of shares: A shares, B shares, H shares, and then ADRs, American Depository Receipts. Which are the shares that are sort of variable interest entities outside of the source from the Cayman Islands, where when you read their 1,000-page annual report, it says we don't actually own the company, we just operate it kind of like a puppet. And people talk about that as a risk. And how severe of that is a risk of, oh, I invested in company XYZ, and from 2023 to 2033, their earnings grew 20 times. But I see none of it because I'm a shareholder, in Tennessee.
So those would be the ADRs that are listed in the US, but the variable interest entities that nominally are going to kind of track what's on the Chinese market. A shares are then the ones that are denominated in RMB and trade on the mainland there, and then you have like the H shares which trade in Hong Kong, which tends to be one of the ways that foreign institutional investors will kind of invest in China.
Now, is it true that it's illegal for foreigners to at least the law is it's illegal for foreigners to invest in Chinese stocks? Technically, obviously, there's a lot of workarounds.
No, I don't think it's, well, look, the Stock Connect shows you that it's not illegal. No, and there's these two programs that have been, they were actually quotas, and then they relaxed the quotas, like the QFII and the RFQII, which was basically like if you can use a registered entity. So if you were like a hedge fund, let's say, you would, you could go to a broker in Hong Kong, put money with that broker, instruct that broker, which at the time needed to be approved. But anyway, I'm not going to go through all the steps. Essentially, use that broker to then transact, buy shares buy A shares listed in the mainland, and then you would kind of have a claim on those A share assets. So no, it's not illegal for foreigners to hold domestic Chinese assets. I would argue like that's actually what the Stock Connect program is designed to do.
How worried are you about the so-called reverse CFIUS of the U.S. imposing restrictions on foreign investment into Chinese property, Chinese private equity, and maybe even stocks?
So that was, a huge deal a couple of years ago, I think even last year maybe, as the tensions had ramped up. It's a concern. It's an unknown. I think from the economies are so intertwined that, China owns a lot of U.S. treasuries. So it can just go into this like tit for tit kind of escalation there. I think for the Chinese, that's definitely a problem, because if you don't want to be reliant on exports as your sole growth model, well, you still need capital flowing into your economy. You still need to finance investment. And so, stocks and bonds are an efficient way of that being done. And so I would argue it's in the best interest of both the US and China to get a deal on this. But it's one of these things where the severity of that risk is very high, but I can't place a probability on it. And so it becomes difficult for me to kind of think about that.
That makes sense. Well, Aidan, thanks. We've done an hour on China. If you'll stay, we'll do a few more minutes just on the macro. I just checked. I hadn't checked before checking, but the bond market has a huge sell-off as well. So I think pretty much every tenor of the yield curve is once again at the highest yield since 2007 or 2006. The 20-30 year are now both above 5%. So the bonds onslaught in bonds continues. Do you think it's close to being over? I mean, so many people have said, up, now's the time to buy bonds, up, now's the time to buy bonds, and they've been, blown out of the water. But it seems, I mean, the move is extreme. The Federal Reserve is probably close to being done hiking interest rates. You tell me. And then there's the term premium issue, which there's the supply issue. What do you think?
One of the reasons to be a little bit more cautious as it pertains to duration, at least, is the fact that it's not clear that the Fed that the economy is slowing sufficiently for the Fed to, start cutting or back off here. We got, the retail sales numbers that came out, the inflation data that came out here is supporting the growth side of the economy. And look, there's, we put out a note today that showed a lot of delinquencies in terms of credit cards and autos and some of these other pockets. So it's not to say that there isn't weakness out there. There is.
It's normalization. It's delinquencies to a 2019 level, which was historically low. It's not,
Yeah, so you're having pockets of this weakness here. But I think what's maybe more concerning for investors in duration is the fact that, and this is kind of the big problem for Powell, I think, and I think he recognizes this, is Powell needs to get commodity prices down in dollar terms, because very rarely have you seen periods where the broad dollar, so the broad like trade weighted dollar, is strengthening, but commodity prices are also strengthening, right?
Mm-hmm.
And so I think the problem is that if you get this kind of strong dollar, which has limits as to how strong it can appreciate from here, but commodity prices keep ticking up, then what you end up doing is you lift inflation expectations. And actually, if you look at the spread between like break evens and the 5-year inflation swap, which the latter tends to track oil prices, inflation swaps are telling you that, hey, there's more inflation coming. And actually, when you look at what's helping to, or at least what's contributing to the bond sell-off here today, it's this pretty big uptick that you're seeing in energy prices, right? Coming out of the what looks like an escalation of the Mideast tensions here. So you have higher commodity prices, which are fueling inflationary concerns, and then the growth is still holding up. So why would I be buying duration here?
Wait. So I'm looking at inflation expectations, the 5-year forward inflation break even, derived from the TIPS, Treasury Inflation Protected Security. That rate actually hasn't gone up that much. It's at 2.5%. And in May of 2022, it was at 2.6%. What's gone up is the term premium, which basically is what's the unexplained thing. You have the equation, and then you have an error function, and then it's my understanding the term premium is basically an error function.
Okay, so two things. I think we're mistaking two terms. So there's break-even inflation, which is the difference between nominal treasury yields and TIPS yields, and that essentially is that spread is the inflation rate that would make an investor agnostic, i.e., break-even between holding nominal and TIPS. What I'm actually talking about is 5-year inflation swaps, which are not the break-even inflation. So as of right now, the break-even inflation that you spoke about, which is nominal minus TIPS yield, is pricing in 2.4% inflation over 10 years. So that's what the 10-year break-even is. And if you look at the 5-year inflation swap, so just a different measure of inflation over 10 years, a more market-focused measure, because actually I would argue that the Fed's balance sheet is distorting the TIPS market. But anyway, that's a different conversation. So if you look at the 5-year inflation swap, that's actually pricing in inflation of like 2.7%. And that measure, that inflation swap, tends to follow energy prices.
What was that 3-6 months ago? Is it gone up?
Yes. So it hasn't gone up much, but it looks like, let's say we were at like 250 and now we're at 270.
Got it.
And so kind of those are the rough numbers there. And so that's what's helping to fuel this increase in the term premium, because the term premium is really, do I want to hold a 10-year bond, or do I want to buy a 1-year bond and then roll that over like 9 times, right? So the risk to holding a 10-year treasury rather than rolling over a 1-year bond 9 times is the fact that, hey, inflation and growth are difficult to predict over 10 years. And so I need a higher return as a bond investor for taking that risk of duration, because growth and inflation are difficult to forecast. And so because the Fed had taken a lot of duration out of the market via the asset purchases, the term premium was actually quite negative. But as you start to get some incremental supply of duration, and perhaps more importantly, as inflation expectations and energy prices are starting to drift higher, and there's some concerns about stagflation, all of a sudden you've seen this lead to a backup in the term premium, which is, look, like growth and inflation are pretty uncertain. If you want me to hold duration, you need to compensate me for that. And I think that's what the uptick in the term premium has mostly been about.
Got it. So you don't love bonds here. You don't love duration here. What do you think about U.S. equities?
So U.S. equities, I think you're probably okay in pockets of the mega caps. The issue I have with U.S. equities is the fact that, so if you look at what typically drives U.S. equities, it's going to be Passive flows, which, Mike Green has talked a lot about. So the target date funds, as long as people have jobs, every 2 weeks they get a paycheck. That paycheck just blindly buys, QQQ, SPY. It takes the market cap weighted stocks higher. However, the other factor here is the ability of banks to use their balance sheet in order to facilitate, some of these like riskier asset trades, right? So, for example, when the Fed is doing quantitative easing and the Fed's balance sheet's increasing, it typically means, bank reserves are increasing commensurately. And bank reserves, it's not money that can be lent into the real economy, but bank reserves are things that flatter banks' capital and liquidity ratios, allowing them to take more risk. All to say that when central banks are doing QE, the cost of banks' balance sheet is cheap. So if you're a hedge fund and you want to go lever up, a junk bond trade 10 to 1, when there's QE, sure, you'll find a bank to take the other side of that and give you that leverage. We're actually seeing now, and likely to kind of intensify going forward, is not only are we going to see continued quantitative tightening, but you're actually going to see a shift in treasury issuance away from T-bills, so away from kind of the front end of the curve, which has been able to be financed by the money market funds, towards duration, which is going to crowd out riskier assets. And this is something we saw in 2019 with the initial repo market blowups that we saw. And so to bring that back to equities is, as treasuries and the kind of the issuance of duration starts to crowd out, start to compete essentially for scarce dollars, that's going to be problematic for risk assets, including equities.
So what is your economic view? Do you think the U.S. will continue its resilient growth? It will have a slowdown, or it will have a recession?
What Powell needs, what the Fed needs, is the Fed does need a recession to play out. They need the labor market slack to pick up. They need unemployment to rise. They need wage growth to slow. And so Powell and the Fed can't come out and tell you this, because if there was a press conference and the Fed governors were telling you we need to get unemployment up to 6%, they'd be lynched. They couldn't walk down the street, right? But I think that's fundamentally what they need, is they need to get growth and inflation down so that they can be convinced that inflation will remain tepid and that their cuts won't kind of lead to a scenario that we saw in the 1970s. And I think that's kind of the conundrum for the Fed, right? Because, and I will answer your question, just kind of forgive me here, but when you think about the way tightening cycles typically work, it's the Fed increases rates, equities sell off, like multiples contract, earnings slow. That earnings slowdown tends to lead to unemployment going up, leads to cool inflation. The Fed's like, oh, okay, check, I can cut. But now what you've seen is Fed hiked rates, multiples contracted for a brief second, elevated again. Earnings actually were stronger than the market was expecting, and unemployment really hasn't budged. So I don't think the Fed can actually cut here. And I think when it comes to soft landing, no landing, hard landing scenario, if you were to look at one of the charts that I really like is the unemployment rate versus jobs hard to get versus jobs plentiful. Because the jobs hard to get minus plentiful, it tends not to be noisy. And when it moves, it continues to move in that direction and it leads unemployment. The unemployment rate tends to be nonlinear, right? So it'll go and then it's going parabolic.
It goes.
It goes, right? So I just kind of look at this and I say, part of the problem with kind of economics and forecasters is, as someone who studied economics, what's drilled into your head every day is derivatives, right? The rate of change. What I would actually argue is, in this context, it's not the derivative, it's the opposite. It's the integral. It's the pressure on the curve that really matters, which is to say, if you have rates at 550 for 3 months or 6 months, that pressure on the economy is different than if you have rates at 550 for a year or 2 years, right? And so just to put this in the Canadian perspective, which I hope is understandable, the Bank of Canada has said, look, as a response of the variable rate mortgages and the interest rate increases that we've seen in Canada, the average mortgage payment has increased by $1,000 a month, and that's just the interest component. So, okay, what is if let's say that just stays the same, $1,000 a month. Well, the rate of change is zero, but after 3 months, well, honey, actually, maybe we have to cancel the vacation. After 6 months, we got to delay the car repair.
Mm-hmm.
After 9 months, maybe things start to get a little bit hairier. So I would argue that the Fed needs a harder landing, which isn't to say a financial crisis. Word. They just need a traditional economic slowdown, and expectations of a no landing or soft landing where somehow inflation cools, but the labor market stays resilient. Just, I can't really square how that would play out.
So if that's your base case, you said, I presume that you see an opportunity to get long durations in the near future. It's just not now.
It's just not now, not while you have growth still resilient, and perhaps more importantly, not while you have these kind of like global crosswinds that are pushing inflation higher.
Got it. Well, Aidan, thanks so much for coming on. Tell us, and the audience, where can people find the work that you do at PGM, and what do you broadly do beyond this?
Sure. Yeah. So I run the global macro strategy and research team here at PGM. We put out, actionable, concise daily work for institutional investors. So they can, either reach out to me on Twitter. I think you have my handle up there at Aidan Garrib. On the cover of the presentation deck that I'd sent you, my email address is there. It's agarrib.
Yeah, can we share that like as a PDF?
Sure, yeah, I can PDF that for you. Yeah, so it's agarrib at pgmglobal.com, or you can follow me on Twitter at Aidan Garrib. I don't tweet prolifically, but I definitely do try to engage. When I get questions, either via DMs or just posts.
There we go. Well, Aidan, thanks so much, and thanks everyone for watching.
Thanks, Jack.